Well, interest rates have started to turn a little bit negative as we have gone into the latter part of this week. We're going to dive in and look at some of the reasons why. Today is Thursday, the 12th of December. I hope you are doing well. Well, let's dive right into the averages, y'all. Mortgage News Daily, they've not yet updated for today. It's a little after 2 o'clock. So yesterday they were quoting 6.80 for a 30-year fixed rate. That's the national average, y'all. Should be stated, I've said it many times, our rates locally, especially in Texas, tend to be quite a bit lower than that. And I'm certainly quoting rates that are better than that. So don't take that as a local rate quote. This is just the national average according to Mortgage News Daily. On Friday of last week, y'all, they were at 6.68, and we were excited to bring that news because that was the lowest rates going back to early October. And we were hoping that that was the start of a longer-term trend that we would just continue to see downward. Of course, that rarely proves to be true, and we're going to talk about some of the reasons that rates have popped higher over the last couple of days. We were at 7.02 30 days ago, so we're still about a quarter better than we were this time last month. All about inflation, y'all. Consumer Price Index came in yesterday, a little bit hotter than expected. We were expecting a read up month over month of 0.2%. It was up 0.3. The year over year number was up from an anticipated 2.6 to a reported 2.7. However, that 2.7 is a bit of a misnomer. It was actually 2.749, so another thousandth of a percent, and that would have rolled up to a 2.8 read, which would have, I think the market would have interpreted that as even more of a miss to the upside. Compounding that, today we got Producer Price Index, which looks at more of the wholesale side of the economy, up 0.4%. That was hotter than the 0.2% that was expected. That takes the year over year number to 3% versus 2.4% that was expected. So two reads on inflation back to back, hotter than expected. You would expect that to have an impact on interest rates, and it has. We are seeing the bond market sell off a bit as a result of that. However, when you look at what the Fed is likely to do, and you look at the dot maps that the Fed provides as well as the market expectations, as you see how bonds are trading, the bond market is assuming a 94.7% chance that the Fed is going to reduce a quarter. They're going to ease another quarter on their meeting on the 18th next week. So the markets are even more convinced that the Fed's going to move a quarter in easing. And y'all, when we look just last week, we were sitting at 71% on the CME FedWatch tool, even after that non-farm payroll. So I think as the internals of that report have worked their way through the market, the markets are frankly pricing in based more on employment numbers than they are on inflation. I think they're looking at these numbers on inflation hovering in the mid twos as being close enough to the Fed target that piece of the equation they're viewing as fairly well satisfied from the Fed's expectation standpoint, and they're just looking at employment now. That's my best read on what's happening with these numbers. As always, I'm going to keep a close eye on it, y'all. I was listening to some economists that I trust, looking at what they expect to see for the coming year. The folks that I trust, y'all, are expecting a year that may be up 20 to 25%. Some are even expecting maybe a 30% increase in core volume year over year. Be very nice to see that, y'all. I think we're all expecting that. I think we're all seeing more activity based on consumer confidence now that we've got the election behind us. Folks are just more settled in making longer term decisions. And let's hope that translates into a much better year. Starting to look like it's going to. So more to follow on that. Stay blessed. Stay safe. We will talk to you next week.